Hello, ladies and gentlemen. We are here today with Rachel Oliver. Rachel, how are you?
I'm great, Alex.
Thank you so much for joining us here. I'm really excited for this episode because I think that what you have built and what you and your husband Neil have kind of conquered in this real estate investing space is pretty awesome. And I think you have a lot to share for the public and for our viewers. So truly my gratitude to you guys. So to give everybody a quick update, I was hoping you could explain a little bit about yourself as well as Clover Properties and what it is that you guys do and how you guys operate.
Sure. So we've been around since 2009. I feel like we're relics in the real estate investing world, and we entered this journey with a bit of an underdog strategy. The rent to own strategy about 15 years ago was something that most people didn't really understand. Many people didn't trust it, but we persevered, and so many years later, we've done about just under 900 rent to own deals. So it's been quite a journey, but essentially we match families who need a way to overcome their barriers to home ownership when the banks turn them away. We match them with families who want to help these families get into home ownership. And the families behind the scenes are really investor families like Neil and I, and you and Kaylee, like basically families that want to help other families get into home ownership and understand the challenges, and they lend their title, they lend their name, their credit, and in exchange they get the not just the satisfaction of the profits, and the profits are juicy, but they also get the satisfaction of investing with a purpose. And that's what we do.
No, I love it. I actually think, in terms of strategy, the rent to own strategy in the real estate investing world is actually one of the ones that comes the most from like kindness and compassion. Not to say that other forms of investing aren't that. I think development and building and creating beautiful spaces and rejuvenating neighborhoods is also like a huge bonus. But I think when it comes to actually the dream of home ownership right now is definitely on the forefront of like the news, lack of affordability. People can't get into housing to save their lives. The thought of, the Canadian dream or the American dream equivalent, right? Of people like, getting out of college, buying a house, getting married, settling down. It's starting to become this fleeting idea for a lot of people. And I think rent to owns is a really great uh, way to combat that. And so I think a lot of people just don't know about it because, you know, for lack of like, people when they're not educated on these things, they tend to think it's sketchy or maybe it's a little weird. But maybe we could talk a little bit from the onset. So from a potential tenant's perspective, um, I know that obviously there's people who don't quite qualify out of the gates. But what are some expectations you have of tenants for them to be good potential candidates for rent to own?
That's a really great question. I think at the heart of it is affordability, and a lot of people misunderstand rent to own. It's like the elephant in the room. Rent to own is not a kind of red carpet for anyone who doesn't have a job or a business income or doesn't have any money saved towards a down payment. Rent to own is an enabler and a facilitator. So the ideal people are the ones that have a strong combined household income. They are people who have been saving. They might have 4 or 5% saved up, but that goalpost to ownership keeps moving as real estate prices keep going up. So that 5% is so difficult. Or, if people had 20% in their head that they need to save up. Well, if it took you this long to come up with 5%, God help you to get to 20%. And what will real estate prices be? And 20% of what? It's just such a and it seems like such an intangible, out of reach goal. But nonetheless, people who have been working at it are ideal for us because they already have transitioned mentally that they want to own. And they are going to take measures to get there. And more importantly, they're also going to be coachable. So that's another consideration, because rent own is not a set it and forget it, like a lot of investors think. Once the people get into the rent own process, and really to get into it, is just a function of having income, having down payment. But to thrive in the rent to own process and come out on the other side at the finish line and take ownership of the property, well, that's a whole different strategy, and that requires a whole level of different tactics and different commitment and different focus. So that's why we look for people who are also coachable, because we work with them through that journey to make sure that they come out successful on the other side.
For sure, for sure. Would you say that, especially over the last few years with interest rates having gone up as much as they have you seen a lot of like kind of restructuring tenant owner agreements on the back end just to kind of be able to still help the process along? Because I know that it's been unprecedented how quickly interest rates have gone up. It says that it's never gone up this quickly at all in our history of like tracking interest rates.
Yeah, Alex, I mean, I hear what you're saying. Rent to own in that sense is really a locked in contract. And, real estate investing is not guaranteed. There's no crystal balls. I know in the last 15 years that we've been doing this, the last year and a half has really taken, a little bit of veer off the road. It's not a straight path to success for anybody, whether it's the tenant buyer or the investor. And we keep the contracts intact. So there really is minimal renegotiation. And if anything, we want our tenant buyers to complete the process and exit as early as they can, and will enable them to do that. So many of them have been working towards ownership, and sometimes they get, situations where they get an increase in their salary, or there's some sort of an inheritance that allows them. We actually had one tenant buyer who won the lottery, so it allows them to
That's
actually
awesome.
fast track their ability to exit the rent to own game. And our investors are more than happy to accommodate that without any severe penalties. But if they stay the course, and the price that they were locked in at and the monthly payment that they were locked in at, that's honored all the way through. So us as investors who purchased, at the lowest interest rate points, I know we had some properties at 1.8 interest rate and 2.2 interest rate. And initially when we took those rent to own deals on, and even some of our investors, the cash flow was $1,200 a month, $1,300 a month. And we were like, yeah, cha-ching, cha-ching, celebrated too soon. Because in reality, when mortgage rules changed and interest rates skyrocketed, well, that cash flow went down to this. We were still ahead of the game. Most of us were
Mhm.
still ahead of the game, but in relationship to what we signed up for, it shrunk. But in relationship to a lot of other investors out there that had rental properties and other projects that they were kind of caught dead in their tracks in, they were more in the red than we were. So I
I
feel
was
like we had some insulation.
Yeah, what I was going to say is that the beauty of the rent to own program too is that traditional rents, like when you're looking at fair market rents, the rent to owns will typically exceed that quite substantially, actually. So I don't know if there's like a margin that you guys look for, like at a certain price, a rent to own three-bedroom will be 20% more than a rental or than a typical rental of a three-bedroom or something like that. Because at the end of the day, part of that is their commitment to eventually buy the house. Can you maybe speak to that in a little way?
So I think a lot of investors, you yourself included, operate from the lens of property first, and property and profits kind of go hand in hand, which is kind of where your question is coming from. If it's this kind of a property, is it this kind of a increase in rent? But with rent own, I'd urge you to look at real estate investing a little bit differently. We really are about the people first. We start with the people, then we figure out
Mhm.
what property will make sense, and then of course profits will follow that. So to answer your question, we really look at the people. What is it going to take for those people to be able to qualify for a mortgage on a particular property based on their current credit situation, their current income situation, and how much down payment they're bringing to the table? And then we work it backwards from there. So it isn't a hard and fast formula of like, let's take
I
20%
can
for
see.
this and add it. It's more about what is it going to take for them to have 10% on the future price of this property? How much do they
Mhm.
have today? And how much do they need to make up during the rent to own process? So that extra that they're paying each month, that forced savings, is really a function of what it will take for them to have a 10% down payment credit of the future purchase price.
That's actually a very good point that I don't quite understand. Every single month, when a rent to own person, when a rent to own tenant, sorry, is putting money into a property, is that is that part of the rent to own, like a portion of it being saved for them in like a separate account? So let's say I'm a tenant and you're obviously facilitating this rent to own, and my family and I are living in a detached 3 bedroom, 2 bath house. I like that idea, working it backwards from what the fees are, because you and the financial partner are covering the mortgage payments, correct?
Correct.
And the tenant's paying all the utilities, they're paying the property taxes, they're paying the insurance. So any of the fixes, repairs, and maintenance that need to be covered on that. And let's say your financial pay, the mortgage payments on this are $2,000 a month. I'm paying $3,500 a month. I'm trying to understand how it works because part of the rent will go into like a forced savings account for the tenants, right? So if I'm a tenant who's, let's say, paying $2,000 if I'm a tenant who's paying $3,500 and you're the investor side of it facilitating this deal, and your financial commitments to the bank are 2,000, there's that differential of the 1,500. How do you distribute what goes into like a forced savings account and what is pocketed as potential cash flow on a typical deal?
So the tenant is really covering the mortgage, the property taxes, and property insurance. That's kind of their, their monthly payment, part one. Part two of the monthly payment is really a function of how much do they need to save up each month to get to 10% of the future purchase price. So, for example, if they come in with, $30,000 on a $600,000 property, we know that we need to get them to at least double that. So we want them to have at least $60,000 towards the down payment of the future purchase price. So that's
Mhm.
really, the math. They're in the program for 4 years. So $30,000 divided by 48 months gives us kind of that over and above. So that $1,500 piece, the calculation actually comes from how much of a down payment we need to force them to save based on what they're coming in with today and where we need them to exit in the future.
I'm just wondering, is that something that you guys accumulate into your accounts, or is that something that, like at the end, when the tenant buyer is about ready to take over the property fully, do you guys credit them that difference on close, almost like that 30,000 to 60,000 example, for example, you need to double that amount, and let's say they close it on 600, do you give it to them for 570, and that gets credited on close?
You got it. So what's really happening is that we're allowing them to buy the property incrementally. So today they might have $30,000. It's not enough for the banks to say yes to them. That's okay. The bank of, Rachel and Neil or the bank of Alex is good with that. So we'll take their 30,000, but they agree to pay us the other 30,000 each month. Kind of like when you buy from a builder. You've bought new construction before, I would imagine. So, you know how you
Mhm.
give the builder a lump sum at the beginning, and then over a certain period of time, you pay other installments. That's exactly what we're doing. And when it's time to take occupancy or take ownership of the property, that total amount that was paid as a lump sum plus the installments gets added up and reduced from that future purchase price that is locked in at the beginning.
Oh, awesome. Awesome. I actually cleared that up because that wasn't one aspect of the rent to own side that I didn't quite understand. So that's good. And so, in terms of investors, like what kind of returns do you typically see from like a rent to own side?
So we've been blessed in that. I mean, for our investment deals, um, we can keep it consistent, usually at about 25% annualized. Now, that's taking into account, qualifying for an A lender mortgage, coming in with 20%. I'm not tying up 20%. I'm actually only tying up 15% of my capital, which is a big benefit to where leverage comes from, right? So if I've got 5% coming in from the tenant buyer side, and I've got the other 80% coming in from the bank, I'm in really for 15% of my own capital. I don't have to worry about renovation costs or any additional, repairs or vacancies. So it really gives me a predictable kind of runway for the next 3 or 4 years, depending on how long this rent to own term is. So
Mhm.
I forgot what I was answering. Ugh, I had a brain fart. I wanted to add something to it. Completely forgot what I
No,
was
that's
trying to
okay.
answer.
That's okay. Okay, so when it comes to market like fluctuations that we've seen, obviously in the last year, property values have been suppressed. Have you found situations where you've been in a contract with a potential rent-to-own buyer, and now they're going to take over the property, but an appraisal or somehow property gets valued for less than what they've committed to? And how do you go through those kind of circumstances? How do you make sure that everything works itself out?
That's a great question. So we generally play in a very specific type of price point to mitigate that risk from actually being a concern. We are in that entry level price tag where buyers are looking for entry level homes in desirable family friendly communities. So there's usually a gap in inventory. And we've been doing this for 15 years. So the strategy has carried us consistently in being able to see that when we play in that entry level price point, there's always a deficit of properties. And when there's a deficit and a higher demand, we're constantly shielded from the market fluctuations. So at the end of the rent to own process, all of our families actually have seen not not necessarily um, full accuracy in terms of our predicted appreciation rate, but they actually are seeing their properties worth a little bit more on the open market. So what we're enabling them to do is buy slightly below market value. And in the investor language, we're leaving a little bit of money on the table because I believe in win-win, and I believe that
Hmm.
actually has created a more predictable, sustainable investment model for everyone involved. So we actually don't run into that discrepancy where the property is not valued um, appropriately at the end of the rent own process. The property is actually valued slightly below. Now, where we do run into challenges, and I don't want to paint the picture that there's no risk, there's no turbulence, that everything is hunky dory. Absolutely not. Rent to owns, like any real estate investing strategy or even stock market investing, they all come with a certain amount of risk. And it boils down to how long you've been in the deal for. So if you buy a stock and you sell it prematurely, and if you're selling it prematurely when when the markets are up or down, it's going to impact your profit. So very similar with rent to owns. So where there's potential risk or potential volatility is that if the tenant buyer stops paying in the first year of the rent to own, or even maybe in the second year before there's been too much mortgage pay down, or before there's been enough of that 5% annualized appreciation that we are accustomed to seeing for these entry level homes. It could be that year where there was more of a 2.5% annualized appreciation, but we know next year it's going to be 5.5%, and the year after that it'll be 8%, right? Because the market is constantly doing a little bit of a dip and then it levels out, maybe a dip and then levels out even more. So if the tenant buyer aborts their rent to own commitment on that year when we have a little bit of a dip, and usually it's in the first year. The first year of rent to owns is probably the riskiest because not enough mortgage paydown and potential dip in the market. That's when things can get a little bit interesting. But that's how we have learned that over the years. I mean, we've done this a lot, and mitigating that risk really is a function of screening the people more effectively for the rent own process and making sure you know exactly who you're bringing in, because with rent to own, it's not the property that pays for itself, it's the people. So if you mess up on bringing the right
Hmm.
people into the mix, then that's where you can take a hit. Now, when I say take a hit, okay, so if one of our properties goes sideways in the first 12 months or in the first 24 months, the tenant buyer has to walk away from 30, 40, $45,000 of their hard-earned money. They leave that amount on the table. And that ultimately serves as a bit of a cushion for us to
Hmm.
rebound from that unpredictable detour.
Yeah.
And generally, in a market like this, where we're seeing kind of, If somebody started the rent to own process last year and they're aborting it at, 2 or 3 years early, the price is not going to be there. And we haven't had a ton of mortgage pay down because interest rates have been so high. We use that tenant buyer down payment credit to help us break even, to help us recoup. Now, in some cases, if you have the stomach for being a landlord, you can transition that property into a rental, and you can get great rent for it because it is, to some degree, in certain areas, a renter's market. If renting out the property is not something that you can stomach, which for me that was a big hurdle for a long time, I opted to sell, and oftentimes I basically break even. So the cushion that the tenant buyer left on the table offsets my real estate costs, the carrying costs until I close, all of those things. So it's a wash. But the way I
I
look at
do
it,
think
Alex, oh, go ahead.
I do think that honestly the benefit for any like potential tenant or potential rent to own, tenants that want to listen to this podcast and are like getting some ideas from this. The beauty of it though is it's in their hands at the end of the day for them to pay or for them to come up with the cash. So should there be a cushion? Of course, you kind of need that commitment level. But if it fails and someone has to walk away from 30K, that's on them. You know, that's
Yeah,
a good
exactly.
thing to have. It's not, you know.
And one of the things that we're really good at is trying to troubleshoot and trying to understand what is the heart of the problem. How can we help mitigate? Because a lot of these tenant buyers, when they run into a brick wall, oftentimes they don't know what they don't know. So that's where our expertise really comes through, because we've seen the good, the bad, the ugly, and then some on how things can go sideways for them. And we have so many solutions under our, under our belt that we will gladly introduce them to and assist them through. But what I find sometimes is that the tenant buyers themselves, they hit that wall and they shut down. They can't overcome their own, they stand in their own way of even hearing a possible solution. It doesn't have to end in us, moving them out and them losing that 30, 40, $50,000. It doesn't have to end that way. They
Mhm.
just need to resolve themselves to seeking the help and taking our guidance so that we can help them preserve it. But oftentimes they choose not to. And that part is really heartbreaking for me in this entire real estate investing strategies that we try to help, but not everyone wants to receive it.
Yeah, you can lead a horse to water, but you can't force them to drink. I get it. I totally get it. So it's funny actually. We just dealt with a tenant situation where this girl caught up after 2 months, and we're like, listen, we actually really like her. We're like, we don't want to have to kick you out, but like we have to go through the motions. We had to apply for the L1, and I'm like, listen, like we'll obviously work at a payment plan with you somehow. She's like, I'm committed. I'm gonna figure this out, and she did. And like, hallelujah, it's good honor. So I think that just like in a rent to own situation, like you got to figure it out somehow. You got to make it work because 30,000 or 50,000 is not a little bit of money to walk away from. So that's
Absolutely.
awesome.
And
And
they lose sight of what their goal was originally because they're dealing with some sort of other personal setback. It could be like a divorce or maybe a separation or even a job loss. And they just have to
yeah,
dust themselves off and look past whatever the short term setback is and allow other people to guide them. And when they make that decision to get through it, they'll come out, much wealthier. I don't mean just financially, but much wealthier in terms of growth. They'll come out on the other side. And that's really what I think we thrive at and we're good at. But like you said, you can lead the horse to water, but not every horse wants to drink. Some people just want to get caught up in feeling sorry for themselves. And I feel sorry for them.
yeah, yeah, that's wild though. So 900, over 900 of these you guys have done, which is seriously impressive, by the way. Um, when it comes to the actual, so to the viewers listening, when it comes to the actual logistics and how to do rent to own, definitely give Rachel and her team a call. You guys obviously know your stuff. But I'd like to transition a little bit into the business side of things. How you guys see things growing? Where do you see rent to owns going? Because I know that there was some, and I might bosh this thing up. CMHC was going to create like an allowance for rent to own funding, I guess. So maybe you can speak a little bit about that. Are you familiar with what I'm referring to here?
Yeah, absolutely. I was actually on a small group of advisors and I guess rent to own operators in Canada. And I was invited alongside two other colleagues who understand the rent to own space to advise CMHC on best practices and what they need to take into consideration in enabling more Canadians to go through this rent to own process. We put together a really detailed um, report for them. And to be honest, it's probably a paperweight at this point. I'm not sure the CMHC actually did much with that information other than just say, "Oh, this is too much for us to do. Let's just toss it." Um, you know, what's interesting in what we're even talking about. So on the one hand, you have CMHC saying, "Yeah, let's fund private sector, not for profit, to offer rent to own programs." But really, what they were saying is that, "Hey, private landlords, hey, developers, what we want you to do is get some real estate properties, buy them at today's real estate prices, cover the costs of the construction at today's prices, or hold the property on title at today's interest rates, but allow more families to rent own that property $1,000 or $2,000 below what they would normally pay." Right. Process that for a moment,
That
right?
doesn't
This
really
is what
work.
the ask
Yeah,
was.
yeah,
We'll give
yeah.
you some sort of a support, but you're committing here to buying stuff at today's prices, but offering a $2,000 monthly discount so that more families can rent to own. They had, I think, false expectations as to what's doable and what's realistic, and I'm not sure that it's going to have a lot of legs. So on the good side is that they're using the language and they're giving people hope. On the bad side, we
Mhm.
have pitiful execution, and it's been a few years now, and not a lot of movement. And in fact, the rent-to-own operators that have applied to support this program and to potentially be eligible for funding have all come out empty-handed, and definitely worse for the wear, because dealing with this type of a application process has not been a no-brainer. It hasn't been easy. And then on the other piece, and the kind of, you have this triangle of of issues. The other piece of it is CMHC doesn't fully recognize the down payment credits that homebuyers accumulate through the rent-to-own process. So when we're exiting rent to own deals and our tenant buyers are applying for a mortgage, they obviously have to qualify for financing with the bank. But then on top of that, because they're
Mhm.
coming in with less than 20%, they still have to qualify with an insurer. And that's usually CMHC back there. And CMHC doesn't recognize the down payment credits that people accumulate through a rent to own agreement.
So how do you guys get around that?
Well, there's obviously other funding avenues, and in many cases, there's other insurance products that other insurers that we can go to other than CMHC. So there's definitely workarounds. But what I'm trying to, put the spotlight on is that we got CMHC trying to enable rent to owns through new policies and new funding programs, which may or may not be, doable. But on the flip side, you have CMHC that's kiboshing anyone who's gone through a rent-to-own program and stopping them in their tracks, saying, "Sorry, we don't think your down payment credits are where you say they are." So how is that even logical? I think I think the bottom line is that it's up to us, private sector, individuals, investors, to take a leadership role here and and make a difference. Because if we wait for the government to try to support us or to try to lead the charge, I think that there'll be still a lot of home buyers who are locked out of the ownership game.
Ain't that the truth? Unfortunately, I agree with you. It's it's funny. The word profit has uh, it's almost like this negative connotation around the word profit nowadays. Yeah,
You're
you get
froze.
this guilty
You
feeling
froze.
inside of you if you're like trying to do something for profit, and I don't understand why that is. Um, Well, I guess I kind of do understand why it is. Young people are frustrated. You know, they're thinking that these people are profiting exorbitant amounts of money, and they're the ones sacrificing, the next phases of their dreams, right? But I see it all the time here too. Like Hamilton City Council is voting on some sort of policy change that is very, very crucial to rental housing providers, and anybody on the council who owns a rental property has to abdicate from the vote and say, sorry, I can't vote because I'm a rental housing provider. And I sit there like, how stupid is that? Like, you should have half maybe tenants and half landlords sit in a room and discuss these issues so that you can get a full grasp of it, instead of people who, and then they can use the data or whatever results come from hashing that out to make an educated decision. Because unfortunately, you get the double edged sword. You have nobody who wants to develop, or nobody who wants to create programs like a rent to own or facilitate, because they don't understand it and they think it's all just a profit scheme. Yet they cry wolf because there's not enough affordable housing out there and people can't buy houses. So that's the
Yeah,
crux of the
it's
last decade.
it's absolutely it's mind-boggling. It's almost like it's a delay tactic, smoke and mirrors. I don't really know. I mean, at the end of the day, hardworking real estate investors who are there, boots on the ground, are trying to solve the problem, and we have track records and we have a lot of experience to share. Why is that not being considered as they try to rebound from this problem? It's not going to get solved from the ivory tower.
Hmm. That's for sure. They'll spend your money though, you know.
They'll spend your
And it's
money
funny
trying
you
to
say
solve.
that. Yeah, yeah. It's funny you said that big report that you guys provided was a paperweight, but I guarantee, like seemingly that's what they love. You know, they'll just hire a consultant to do the studies so they can make a decision based on what the consultant has spoon fed them, instead of actually just getting some good insight from people on boots on the ground and then voting on it, making things happen. So anyway, this is alcohol conversation worthy griping, but so as part of this podcast, the Real Estate Leadership and Legacy podcast, you and Neil have really grown into leaders in the rent to own space. I mean, I remember when I actually first joined Rain. You probably don't remember this, but you were actually on stage and we sat at the same table together, and I was just some nobody at the time. But it was interesting to be like, whoa, cool! I'm sitting with these guys. They were just on stage, and obviously there's a massive influence on that you have in this space. And so first and foremost, hats off. It's not an easy feat to compete in an investing space. So you guys have done a tremendous job. Where do you guys see your business going? Like, where do you want to grow? Like, how much do you see it growing to? What's the next phase for Clover Properties?
Well, thank you. I mean, I really appreciate the kind words, and I don't remember sitting at the table with you at Rain, but I'm so glad that our paths crossed in the future, and
Yeah,
here we are today. And you've done a lot of amazing things.
exactly.
So my hat's off to you for accomplishing what you set out to accomplish.
Well, thank you.
I mean, I think as a leader, you're constantly innovating. And as a leader, you're constantly solving problems that other people might not even be aware of. And I think that's where the next step is. I see hurdles, I see challenges, and I want to solve for them. I want to I think expand. I mean, we've been playing in our safe Ontario backyard for a very long time. And recently we have expanded into Edmonton and into Calgary. And I think we need to continue that expansion because what we offer is a viable, proven solution for so many homebuyers and investors who want to maximize profits and minimize problems. And that's really what we offer. And marrying, those families with the families that need help, that mission of families helping families is really, really near and dear to me, and I want to take it across Canada. But I don't think that I'm going to take it across Canada solving the same problem in how I did it in Ontario. I don't see that it'll work the same way in BC, for example. So adapting, I think, is really the next phase. Adapting, tweaking, and growing. I think that's where we're headed.
I love it. I love it. So, with all that being said, I think once again you are a wealth of knowledge, and you're such a great individual too. I'm really grateful to have gotten to know you over these past few years. Especially part of our mastermind and such. Where can people find you? And of course, we'll add all these details to the show notes as well below. But what would be the best way for someone to reach out and get a hold of you?
Well, you can email me directly at rachel@hellocashflow.ca. Or if you're not ready to communicate directly, just go to hellocashflow.ca and check out some information that we have on that site and see if there's anything of interest.
HelloCashFlow.ca. I love that. Okay. Thank you so much, Rachel, for your time. I really appreciate it.
My pleasure. Thank you so much for having me.